In order to ensure that triple screen strategy works properly, first of all, Dr. Elder recommends choosing the appropriate length of time frames that will be used in your market analysis. In other words, each trader has to determine which price charts to work with: daily, hourly, weekly, or others. What time interval should you use? Everything is quite simple here. Every trader has to decide for himself what time frame he is going to trade in. In the triple screen strategy, this time interval serves as a medium time frame. The long time frame should be 1 degree longer, and the short time frame should be 1 degree shorter than the medium. Dr. Elder recommends using 3 different time frames simultaneously: long, medium and short, and start from the medium time frame. After choosing the right medium time frame, all you have to do is to choose a long and a short time frames. How to determine your medium time frame? Suppose you normally open a position and hold it for a period of few days. In this case, your medium time frame will be daily chart. If you prefer to open and close your positions within 1 day, then your medium time frame will be hourly chart. For short-term traders who hold their positions less than 1 hour, the medium time frame will be minutes chart. The strategy is based on the observation that perfect ratio between the lengths of time frames should be 4 or 5. Thus, the long time interval should be longer than the medium, 4 or 5 times, and the short time interval should be shorter than the medium, 4 or 5 times. Let me offer you several different sets of time frames for the triple screen strategy. For example, the long-term traders who hold their positions for a few weeks, the following set of time frames will do. The long time frame is monthly chart. The medium time frame is weekly chart. And the short time frame is daily chart. The second set of time frames may be suitable for those traders who hold their positions for several days. The long time frame is weekly chart. The medium time frame is daily chart. And the short time frame is 4-hour or 6-hour chart. And finally, the short-term traders who hold their positions within 1 hour may choose the following set of time frames. The long time frame is 1-hour chart. The medium time frame is 10 minutes or 15 minutes chart. And the short time frame is 2 minutes or 3 minutes chart. Now we can go to the rules of the triple screen strategy. First of all, let's review the rules for defining the major trend. As were mentioned before, traders should open their positions in the direction of major trend. You can use several different tools and techniques in order to determine the direction of current market trend. For example, if we talk about trend indicators, then such instrument as moving average is considered to be the most popular one. You can use either one or several moving averages to determine the direction of trend. You can also use other analytical tools, for example, such indicator as ADX. Another option is an indicator called Alligator, which consists of 3 moving averages, shifted forward by a certain number of time intervals. One more option is Ichimoku, an indicator which was originally used in Japan. It consists of several moving averages, which form support and resistance areas, and generate trend reversal signals. What method does Dr. Elder use in his strategy? In the original version of his strategy, Alexander Elder used another popular technical indicator, called MACD. How did he do that? Take a look at the slide. The direction of trend is determined by the length of each two bars in the histogram. If there is an uptrend in the market, then the length of the bars should become shorter in case the indicator is below the zero line, and the length of the bars should become longer in case the indicator is above the zero line. This kind of situation is shown in the chart on the left. If there is a downtrend in the market, then the length of the bars should become shorter, in case the indicator is above the zero line, and the length of the bars should become longer, in case the indicator is below the zero line. This kind of situation is shown in the chart on the right. Please note, when indicator is moving from below the zero line, it gives stronger signals to buy than moving above the zero line. And vice versa, when indicator is moving down over the zero line, it gives stronger signals to sell than moving below the zero line. Here is the method of defining the direction of trend in action. In front of you is a weekly chart of a currency pair, Euro, US dollar, and a MACD, with standard parameters 12, 26, 9, which is plotted as a histogram. By the way, it is worth noting that in his later books, Alexander Elder acknowledged that histogram-type MACD was not the best option for solving this problem, because it is quite sensitive and generates too many signals. Alternatively, Dr. Elder also recommended using EMA 13 or EMA 26 on a weekly chart. Let us consider one specific example. Here is a weekly chart of a currency pair Euro, US dollar. One single indicator, EMA 13, is built on the chart. Why did Alexander Elder select 13 intervals as a parameter for the moving average? The fact is number 13 roughly corresponds to the number of weeks in one quarter. That is, it is the length of the natural cycle. By using the moving average with specified parameters, it is quite easy to define the direction of major trend. If moving average slopes upward, and the price is above the moving average, then the market is developing an uptrend. If moving average slopes downward, and the price is below the moving average, then the market is developing a downtrend. Changes in the direction of trend occur when the price breaks through the moving average, and generates dead cross and gold cross signals. If moving average moves horizontally, and the price line crosses the moving average line several times in a row, then it is likely that the market is developing a sideways trend.